Why would anybody refinance a mortgage that they're going to pay $9,000 for and add mortgage insurance, which the loan doesn't currently have? Let me explain this to you. This refinance saves over $300,000. Close this one at the beginning of 2026, and we're going to walk through the details. When we look at this, and it's not even the most important number, I ran the scenario for this gal, and she wanted to look at 3 different interest rates, which we always do on Borrow Genius, and give a break-even point. We know we should do something. Her interest rate was in the 8% range. What we need to know is exactly what we want to do. Well, in setting this up, if she was to take the lowest interest rate with the highest closing costs, it's going to save her $225 a month more than taking an interest rate almost 1% higher, and she's going to break even in over 36 months. She does not believe she will make any changes to this mortgage in the next 3 years and chose the lower interest rate. We provide, they decide. It doesn't really matter to us. Most people still make the wrong decision here. However, in her scenario, this is how she feels most comfortable. When we break this down, check it out. At 8.499, she had no mortgage insurance. Now she's going to have $78 in mortgage insurance. She's going to pay $9,000. She can keep her 8.499 for free. And her mortgage balance is going up almost $20,000. However, she's saving $750 a month in a payment, and the interest saving is over $1,000. So when you look at this break even, she's going to recoup the cost of this mortgage within a year, and she's going to recoup it versus interest in about 8.5 months. Total lifetime savings of the loan is almost $250,000. That sounds like a no-brainer, right? And she also has a change in net bank balance, which is going to be another $10,000. So when we look at this, the entire decision right here, if you keep this loan longer than 12 months, you win. Less and you lose. That's what most lenders never show you, is what is your actual break even based upon what you're doing. Secondly, the lifetime interest of the loan, as we just mentioned. It's not a payment play, it's a wealth move. This is how people retire younger with more money, is they reduce the good debts as well as eliminate the bad debts, right? And with $100 funds to close and a net bank impact of $10,000, it's not draining her account, it's actually improving it, and it's what nobody explains correctly. Let me show you what I mean. In this scenario, we've calculated her payoff. We understand, and she's willing to pay the points in order to get the lower interest rate. We're reestablishing an escrow account. When we took it this 9 plus this 6 plus the payoff, which is another 2, that's where we get the difference between her current mortgage and her new mortgage. It's not $20,000, it's $9,000. The rest of this is the payment she's not making and the escrow account that she's reestablishing. Now, her amount due at closing, she gets $100 back. Then we get a refund of her current escrow balance, and she does not make a mortgage payment in the month of March. She's getting $10,000 infusion into her bank account. That right there is important for her, and she needs that. So we closed in February, didn't have a payment in March. In April, she's got a new payment that's $3,500, $750 less than what she had before. So all of these things together make a big difference. We calculate the exact payoff, the true cost of the mortgage, a real break even, and a long-term outcome. Most people get quoted one option. No comparison, no timeline, no real math. That's how people end up refinancing and losing money, even when the rate is lower. And it's why Borrow Genius exists. Not to sell loans, but to show the numbers. It's not magic, it's just math. If you're thinking about refinancing, upload your statement, we'll run the numbers. Because the difference between a good refinance and a bad one isn't the rate, it's the math.